The history of currency reflects the evolution of human societies and trade systems, moving from barter economies to the sophisticated monetary systems we have today. Here is a brief overview of the major phases in the history of currency. 1. Barter system. Prehistoric times. In ancient times, people exchanged goods and services directly in a system known as bartering. For example, a farmer might trade wheat for the services of a blacksmith. This system worked well in small communities but became inefficient as societies grew and needs diversified. 2. Commodity money. Around 300 BCE, as trade expanded, certain goods began to serve as standardized mediums of exchange, leading to the use of commodity money. These were physical goods that had intrinsic value, such as cattle in pastoral societies, grain or salt in agrarian societies, and precious metals like gold, silver, and copper, which were valued for their beauty, rarity, and durability. 3. Metal coins. Around 600 BCE, the first known metal coins were produced in the ancient kingdom of Lydia, modern-day Turkey, around 600 BCE, made from electrum, a naturally occurring alloy of gold and silver. Soon, many ancient civilizations, including the Greeks, Romans, and Chinese, adopted coinage. Coins were easier to carry and standardize, each marked with symbols or images to indicate value and origin. These coins had intrinsic value because they were made from precious metals, a concept known as commodity money. 4. Paper money. Around 7th century CE, China was the first civilization to introduce paper money during the Tang dynasty, 618 to 907 CE, although it became more widespread during the Song dynasty, 960 to 1279 CE. Paper money was initially used as promissory notes and later became an accepted form of currency. In Europe, paper money emerged much later, around the 17th century, notably with the Bank of England issuing its first banknotes in 1694. Initially, these notes were promises to pay the bearer a specific amount in coins, but over time they became accepted as money themselves. 5. The gold standard. 19th century, the gold standard became a popular monetary system in the 19th century. Countries began to back their paper money with gold, meaning that paper currency could be exchanged for a fixed amount of gold. This system created stability in international trade and lasted until the early 20th century when the Great Depression and World War I put strains on gold reserves, causing countries to move away from the gold standard. 6. Fiat money. 20th century, the world fully shifted to fiat money in the 20th century, especially after the Bretton Woods Agreement in 1944 and the eventual abandonment of the gold standard by the United States in 1971 under President Richard Nixon. Fiat currency is government-issued money that is not backed by a physical commodity like gold or silver but has value because governments maintain it and people have faith in it. Today, almost all the world's currencies, like the US dollar, euro, and Japanese yen, are fiat currencies. 7. Digital currency and cryptocurrency. 21st century. In the 21st century, currency has evolved into digital forms. With the rise of electronic payments and online banking, money has increasingly become digitized. The introduction of cryptocurrency in 2009, with Bitcoin as the first decentralized digital currency, has added a new dimension to the concept of currency. Unlike traditional fiat currencies, cryptocurrencies rely on blockchain technology and are not controlled by any central authority. Summary of key developments. Barter system gave way to commodity money, such as cattle, grain, and metals. The invention of coins simplified trade in ancient times. Paper money revolutionized economies by enabling easier storage and transport of wealth. The gold standard added a layer of stability to currencies but was ultimately replaced by fiat money. And the rise of digital payments and cryptocurrency represents the latest evolution in currency. From ancient commodities to digital coins, currency has evolved alongside human civilization, reflecting changes in trade, technology, and societal structure. Currency control around the world is typically managed by central banks and governments through various mechanisms aimed at stabilizing economies, controlling inflation, and regulating financial systems. Here are key methods by which currency is controlled globally. 1. Monetary policy. Central banks, such as the Federal Reserve, U.S., European Central Bank, ECB, and People's Bank of China, PBOC, use monetary policies to control currency value and ensure economic stability. They can influence currency through interest rates. Raising or lowering interest rates impacts currency value. Higher rates attract foreign investors, raising the currency's value, while lower rates make borrowing cheaper, weakening the currency, money supply. Central banks can increase or decrease the amount of money in circulation, influencing inflation and currency strength, and open market operations. By buying or selling government bonds, central banks can affect liquidity and the value of the national currency. 2. Foreign exchange, Forex, intervention. Central banks sometimes directly intervene in the foreign exchange markets to stabilize or manipulate the currency's value. This can involve buying or selling foreign currencies to strengthen or weaken the local currency, and currency pegging. Some countries peg their currency to a stronger foreign currency, like the US dollar, to stabilize their economy, such as Hong Kong or Saudi Arabia. 3. Capital controls. Governments impose capital controls to limit the flow of foreign investment in and out of the country. This prevents excessive currency fluctuations and shields the economy from global financial instability. Examples include restrictions on currency exchanges, limits on foreign investment or the amount of currency that can be moved abroad, used by countries like China. 4. Inflation control. Currency value is deeply tied to inflation. Governments aim to control inflation by managing economic factors like interest rates and money supply, and hyperinflation can devalue currency drastically, as seen historically in countries like Venezuela or Zimbabwe. Controlling inflation helps stabilize the value of currency over time. 5. Exchange rate systems. Countries adopt different types of exchange rate regimes to control their currency. Floating exchange rate. The currency's value is determined by market forces of supply and demand, e.g., the US dollar, euro. Fixed or pegged exchange rate. The currency is tied to another, usually stronger, currency, e.g., the Chinese yuan, which is pegged to a basket of currencies, and managed float. Some countries allow their currency to float but may intervene to avoid extreme fluctuations, e.g., India. 6. Currency reserves. Central banks maintain foreign currency reserves, such as US dollars, euros, or gold, to back their currency and stabilize exchange rates during economic crises, and a country with high reserves can more easily control fluctuations in its currency's value, as seen in China and Japan. 7. Government policy and fiscal measures. The emergence of cryptocurrencies like Bitcoin has added a new dimension to currency control. Cryptocurrencies are decentralized and not controlled by governments or central banks, although many countries are working to regulate or even create central bank digital currencies, CBDCs. Countries like China have already launched digital currencies, while others, including the US and Europe, are exploring the possibilities of digital central bank currencies to control money in the digital age. The control of currency is a complex and strategic endeavor, managed through a combination of monetary policies, foreign exchange interventions, fiscal policy, and increasingly, digital innovations. The methods and tools vary across countries depending on their economic conditions, global standing, and policy goals. Like, share, subscribe for more tips and inspiration.